Been a big comeback, or I wouldn't say comeback, but a big sell-off in the bond market. Uh, is it time to start getting worried about the bond market, what it is telling you? Suddenly the world is looking very different. Bond yields have gone, or US bond yields have gone back to their pre-COVID levels.
Hi, Nikunj. Good morning. I don't think so. I think, yes, the bond market is obviously the biggest worry for equity investors as well, whether the central banks globally will be able to control the bond yields. But we think we have been expecting, bond yields to move up, both in India as well as globally. As long as the increase in yield is somewhat orderly and we don't see a massive spike, US bond yields going up to, let's say, 2.5%, 3% by the end of this year, that would obviously be quite negative. Or in India, if let's say we see bond yields going up to 7% or so, that would be quite disruptive. But our sense is that doesn't seem unlikely. That doesn't seem likely. And also bear in mind that both the US Fed as well as the RBI Governor earlier this week both reiterated their commitment to keep bond yields in check. And we think at least for the next few months that should be possible. The inflation concerns, which is what's really driving bond yields higher, I think it still remains to be seen whether this is a structural uptick in inflation or whether this is more of a transient nature. There are a lot of supply chain bottlenecks all across. Economies still haven't fully opened up, so production is there, but sometimes either the ships are not available, container movement is not possible. So there's a lot of disruption in the supply chains globally. So I think the bond yields, the increase that we've seen yesterday or even over the last 10 days or so, that's something we should keep an eye on, but not something to be overly worried about at this stage as yet.
Why would you say that? Because the reason I'm asking you and challenging this thesis that we should not get worried is that the minute you look at inflation fear coming back, and there are reasons to get worried about it, because price of steel, cement, price of rubber, price of cocoa, price of orange juice, everything has gone up. Because when the spike comes back, it really disbalances the trade equilibrium.
Yeah, you're right. And which is what I said. I think the short term, definitely we will see, the commodity prices going up. In fact, not just this, even oil prices. I would worry more about oil actually rather than some of these other commodities as far as India is concerned. But I think a couple of things to bear in mind. Firstly, as far as India is concerned, we are not like in 2013 where global bond yields went up and that resulted in a big EM sell-off. Unlike back then, when the rupee actually fell from about 58 to about 68, 70 rupees or so, there's a pretty dramatic decline in the currency. This time around, the RBI going into this bond yield spike is actually sitting on pretty healthy reserves, almost $600 billion. We're actually grappling with dealing with foreign inflows. And if you see a little bit of a correction, which I think is quite natural when you've seen a market which has gone up about 15, 16% in the last 3 months. I think a little bit of an increase in bond yields because of inflation worries is not really concerning. As far as going back to inflation is concerned, I think obviously this year we will see a bit of a rebound in the global economy, given the very sharp decline last year. But it's too early to say that we are at the start of a multi-year uptick in inflation. The Western economy is still facing a generally weak environment. Look at Europe, for example. Even if you see a demand coming back this year, structurally demand is still generally expected to be quite weak. So if you extrapolate beyond this year, I don't think inflation is coming back with a bang as yet. But again, it's too early to say, but at this stage, it doesn't seem like it. This seems good. I think the point I'm trying to make is we don't know for sure whether this is a transient uptick in inflation or a structural uptrend in inflation. And meanwhile, our Indian economy definitely is improving, and we have the ability to deal with a little bit of an uptick in global bond yields and some foreign sell-off.
Pratik, within financials, commodities, some of these pockets that we're looking at currently that have been on a roll, where would you start to center your attention with an eye on returns going forward? We've seen a couple of these that seem to just be gathering a lot of momentum. Cyclicals, of course, that's the larger theme that everyone's looking at, and within that, a couple of these pockets. So what's looking attractive to you with an eye for returns, let's say, for the year ahead?
So in our view, as far as the year ahead is concerned, we like actually the financials. This is clearly the one segment which has somewhat underperformed the market in the last 1 year, last 6 months, last 3 months or so. And this is an area which is one sector which is leveraged to the economy very strongly. Most banks are leveraged plays on the economy. And especially if you're in an environment where interest rates are going to be inching up, the banks actually don't necessarily do too badly, because what happens is your lending rates adjust upwards far more quickly than your deposit rates. Deposit rates, they take a longer time. So banks with a strong liability franchise, we think will do quite well in this environment. And plus, in our view, the worst of the asset quality concerns are anyway behind us. A lot of heavy provisioning has been done by a lot of the banks. Many private banks have raised capital. So in fact, the focus in our view will shift from asset quality concerns to loan growth. And in that respect, we think financials is probably one of the best ways to play, both from a valuation perspective as well as from a growth prospects perspective going forward.
Okay, and would you also be looking at, the larger NBFCs, perhaps also eyeing what's happening in the PSU space, or would you still be sticking to the private sector names?
Well, by and large, the private sector still. Within the PSUs, the only stock we really like is SPI, given its strong, liability franchise. They've cleaned up the books quite well. Capital adequacy is decent. There are some very well-performing subsidiaries as well. But as far as the NBFCs are concerned, I think we like some of the better quality NBFCs, especially some of the auto financiers, where they have a strong, they haven't really been blown up by this asset quality issues, where the capital adequacy is decent, and where most of these companies have the ability to raise more capital in the next couple of years. They're not they've not really blown up their balance sheet as such. And we think some of these will actually come back to the growth path in FY22. But I think in the NBFC space in general, especially in a rising rate environment, you have to be a little bit careful. So our preference would still be the private banks, but some of the top quality NBFCs, we would go for those as well.
Right. Pratik, just wanted to understand, where is it that you stand on the entire staples and consumption, segment? Because while, of course, a major driving factor for, analyzing or evaluating the entire basket is valuations that these stocks are trading at. But now, because of the commodity price inflation, there is the other worry on whether or not volumes are going to get impacted, because there's only that much bandwidth that these companies would have to be able to, pass on the RM costs to the consumers.
No, you're absolutely right. I think raw material inflation is definitely a concern for some of these companies. And we do expect that in the March quarter and perhaps even in the June quarter, you may see margins not improving further. If anything, you might see actually margins come off. But I think the bigger concern is, one, the valuations themselves. These stocks were fairly expensively valued going, at the start of this year. But the other point, I think, is if you take a slightly longer term perspective, looking beyond just the near term correction, which may happen because of the increase in bond yields and worries around that. But if you take a slightly longer term view, the next 1 year, 2 years or so, these are all good businesses, great managements, generating fantastic free cash flow, high ROEs and ROCs and so on. But in an environment where the economy is actually recovering very strongly, and hopefully the next 1 or 2 years also you may see strong growth going forward, then you want to be positioned more in the cyclicals. So even though you may see some comfort in the short term in a bit of a correction right now, the FMCG stocks may perform a little bit better. But from a longer term perspective, I would say you should look at the dip in the market to accumulate more of the cyclical kind of sectors rather than FMCG.
Sure. Pratik, what's the right way of capitalizing on the entire digitization segment? I mean, of course, one end is the obvious one, the Indian IT names. But aside of that, we've got healthcare as well, which is now eating up into and largely getting dependent on digitization. We've talked about as to how e-pharmacy is the next go-to space. Then, of course, there are pure play internet platform companies like an IndiaMart as well. Where within this segment do you find newer avenues or opportunities?
So I think firstly, as you mentioned, IT services, that's an area we still like, despite the strong run the sector's had over the last 1 year. Globally, given the increasing adoption of digital technologies, whether it's cloud services or AI or IoT, etc., we think the runway for IT companies is still very, very strong. So valuations have become expensive, but they're still in our view, we think we will see positive earnings surprises over there for the next 1 or 2 years. So IT services is one. The pure play internet services companies, obviously, but there it's very business model specific. I don't think you can generalize. You have to be extremely careful about the sustainability of each and every one of those business models. But the other way to think about this is also even within the sort of non-tech related sectors, I would say look at companies which are leveraging technology to improve their competitive advantages. So this could be an FMCG major. It could be, let's say a company like Larsen & Toubro, whom we hosted recently at our conference. These are companies which are really using technology to improve their core competitive advantages, whether in terms of operating efficiency, reducing their raw material prices, reducing inventory levels, connecting better with their channel partners, vendors, suppliers, distributors, and so on. So I think I would look at that. I wouldn't look at technology plays or internet plays just as a pure play sector. You have to actually look at the companies which are going to be sort of using and leveraging this technology to improve their competitive advantage. And I think these are the companies which will actually, do extremely well in the long term.
Pratik, let's talk about a common narrative which I hear from everyone. And that's 8 out of 10 brokerages or 7 out of 10 brokerages, which is based on historical parameters, Indian markets are trading at a premium of about 20 to 40%. When you have bought Indian markets at this kind of an P multiple, the future returns are even flat to negative. How would you defend that?
So I think firstly, the headline valuations do seem expensive. I would agree with that. The Nifty is trading at, by our estimates, about 23 times FY22 and about 19 times FY23 earnings. And that clearly seems to be on the upper end of the range. But I think the key point one should keep in mind is that this is a bit like, in my view, a little bit like 2003 to 2008 period, where we saw pretty significant earnings growth. And earnings surprises came through pretty thick and fast. So what seems like 23 times and 19 times FY22 and FY23 PE may actually be much lower. Now, how much lower still remains to be seen, but we think you will see surprises over there. The second point is look at this in the context of the interest rate environment we're in right now. Historically, we've never had interest rates so low. And even if you assume that in the next 6 to 12 months, you will see interest rates going up by, depending on your view, 25 bips, 50 bips, 75 bips, whatever, the lower interest rate environment also justifies a slightly higher valuation premium as far as India is concerned. And third argument is also the macro environment as far as India is concerned. If you do get upsides from things like faster than expected execution as far as privatization is concerned, for example, I think that could result in an even bigger re-rating. You could see foreign investor sentiment towards India become even more positive than what it already is. And I forgot the last point is obviously what's going on with emerging markets globally and the outlook for the dollar. It is a pretty much a consensus view that despite this increase in yields, you will see the dollar weakness sustain. You are likely to continue to see EM funds get more flows. In fact, at Kotak, almost every global EM fund we are speaking to has seen and is seeing strong EM inflows. So that in turn should result in some flow coming to India as well, and that should be supportive. So by and large, I would not be overly worried about valuation right now. But yes, I think it's fair to assume that we should not be expecting the same kind of returns that we saw in the last 6 months, 12 months. The return expectations have to be a lot more moderate given the valuations we are in right now.
How do you propose one should approach commodities? Because that's where in the short term there is action, excitement, demand, and also there is no large pushback which is coming from commodity consumers. You speak to a steel company, they will say the following: it's never been so good for us in our existence. You speak to an auto company, they're saying, look, we are worried about raw material prices, but we have accepted to pass it on. So looks like the acceptance and also the demand for commodities, whether steel, copper, or even aluminum, is very high. Do you think there is money to be made in a Tata Steel, Vedanta, Hindalco, or a SAIL?
So as far as commodities is concerned, our view is that the current spot prices or the current spreads, which a lot of these commodity companies are making, that may be a bit difficult to sustain. These are exceptionally good times for a lot of these companies. I think eventually you will see a bit of a pushback from the consumer industries, and you may even see some government intervention at some point. But I think broadly, we do like the commodity space, but it's, again, a little bit more stock specific. So, for example, we do like, our team does like Hindalco and Tata Steel. Hindalco has become more of a converter business, wherein they have 70% of the EBITDA comes from the conversion business rather than, and that actually reduces their dependency on commodity prices. Tata Steel, deleveraging story, generating a lot of free cash flow, paying down debt. They have a captive iron ore in India and so on. Those things help. But broadly speaking, I would be careful of extrapolating the bull run we've seen in commodities in the last few months to say that this is going to be the trend for the next couple of years. Like I said in the beginning, it's unclear whether this is indeed the beginning of a structural bull run in commodity prices and therefore inflation going up, etc. We still have to see whether the Western world will be able to grow as strongly as it likely will this year going into next year.
Fair point. Just to wrap it up on a thought on autos, and auto dispatch numbers would be due in next 2-3 days. When I look at autos, a very strange phenomenon is at play, and I've been wanting to discuss with an expert like you, which is that two-wheelers, when the lockdown got lifted, they were the first one to go up, and they are the first one to plateau. Trucks were the last one to pick up, but are showing signs of lot of fall of buying. How would you approach two-wheelers, considering that two-wheelers are plateauing and CVs are picking up?
So I think the big picture to keep in mind over here is that the penetration level for two-wheelers in India is relatively high, whereas the CV cycle, as you know, last 4 or 5 years, we've had a pretty pretty bad situation as far as CV cycle is concerned. And it's only now that the CV cycle is beginning to come out. In fact, our view is we do think that next couple of years, we'll see very strong demand for CVs, both from a replacement perspective as well as from a new vehicle perspective. As far as two-wheelers is concerned, at the current valuations, we actually prefer more of the export-oriented two-wheelers, something like a Bajaj Auto rather than a Hero, purely from a valuation perspective and also from a longer-term growth perspective. CVs is our preferred bet. The way we would play autos is mainly through CVs, not so much the two-wheelers.
Okay, from the broader markets as well, Pratik, if we were to look for opportunities, I mean, real estate was standing out for a while and continues to do so. We were talking about specialty chem, names on the back of the agri theme, mid-cap IT, for example. Are you venturing into the broader markets in a more meaningful way? Would you see more room for growth on some of the pockets there?
Absolutely. I think in the current economic environment we're in, wherein the economy is coming off a depressed last 6 to 12 months, and going forward, given that we expect a fairly strong economic rebound, followed by FY23 and 24 as well, we think will be much stronger than what what people are expecting right now. And you could see upside surprises from government policy action. Right now, there's a lot of skepticism on stuff like privatization or even interest rates. Real estate, you mentioned, one of the big drivers there is obviously the sharp decline in interest rates, and that's the number one worry in a lot of people's minds. But I think if it's a 25 to 50 basis point increase in local interest rates, that can easily get absorbed. Every real estate company we're speaking to is seeing very, very strong demand. There's a lot of pent-up demand, plus the interest rate decline has made affordability a lot easier as well. And obviously, inventory has actually, we've not seen new addition to inventory, new supply coming in. So the demand-supply equation has gotten much better. Likewise, the housing finance companies is another way to play the real estate sector. So we do like parts of the real estate sector. Chemicals, I think there short term, there may be some concerns given the increase in raw material prices, and we probably have seen margins, sort of peaked out for the moment. But the structural story remains intact. A lot of the European customers, in particular, some of the US customers, they are looking for a China plus strategy. India does stand out as one of the attractive alternate sources of supply. A lot of the chemical companies we have been speaking to, they're very, very confident about their outlook for the next couple of years. So I think that is another segment we like. But overall, yes, I think as far as the some of these smaller sectors are concerned, when you have a more broad-based revival in the economy, they should tend to do well. But I would just caution, just keep an eye on valuations. You need to have your valuation discipline intact. And also, I would be careful of getting into companies where governance or balance sheet, these kind of issues exist. So I would be careful of those kind of companies.
Okay, great. Thank you so much for joining us, Pratik, and taking us through how things stand currently. Good to hear from you this morning.